What's up, YouTube? Welcome back to the best finance channel on YouTube right now. This is a portfolio update. We're sitting at 172.8. But today I wanted to talk about some of the craziness of last week. We saw a bunch of big tech companies reporting, which is always super interesting to understand their numbers and their forward guidance, their spend, how much money they're making. If I recall correctly, we had Google, Microsoft, Meta, and I think Amazon report on the same day, something like that. It was pretty crazy. We saw Meta trade down a little bit and Microsoft trade down as well. Google traded up mainly because of their big cloud commit gains. So they have over like $130 billion worth of revenue committed already to their cloud revenue. So that's pretty crazy. That's why the stock went up so much. We might see 400 here in the next couple of months by the end of the year, maybe. So I wanted to share today why I'm getting out of my Amazon leaps. And also want to talk about my new position, Microsoft. So I'm long 32 shares of Microsoft just as a regular underline. And then I'm long 328 shares of MSFU. I usually go long with leaps or just shares. But at this time, I'm actually going long with a leveraged ETF. So MSFU is a double leveraged ETF that tracks Microsoft, of course. So my position here, I have 328 shares at a 27 average. And I'm bullish on Microsoft from a valuation standpoint. I don't think we're going to see like a major catalyst for them where the stock's going to rip 40%. But they do trade at a lower PE ratio than the S&P 500. Like you're talking the 500 biggest companies of the US, their PE ratio is higher than Microsoft's, which is a high growth company. And tech companies always trade at a higher PE than the S&P 500. So I think Microsoft right now, it's at a great price. This is, of course, not financial advice by any means. This is just what I think in my thought process behind it. But if we look at MSFU, if we see all-time highs again at Microsoft, which I think is very likely, I think if Microsoft doesn't trade at their all-time highs again in our lifetime, we're going to be in trouble. But they're trading at 56.5, which is the all-time high here for MSFU. And my basis is 27. So if we see all-time highs either this year or the next, I'm basically doubling my $9,236 investment here. So I'm being a little bit more patient with my position here. And that's why I went with a leveraged ETF instead of just a leaps. And I'm also already pretty committed with leaps when it comes to my medical. So this contract trades at 30,700. I bought it at like 32.40. So that's a big chunk of my leaps money right now. And I'm actually exiting my Amazon call. We saw a pretty good gain as of now. This is the contract right here. 53% gain. I bought it a couple of months ago, or actually almost a year ago. I'm mainly getting out of this one because Amazon has had a pretty big run already. And Amazon is notoriously bad at keeping their gains. But I'm still very happy with this position and this trade. And I'll keep you guys posted on where I land with this. I might just cancel my limit order to sell it and hold it for another couple of weeks. But this does expire January of 2027. So I'm going to have to sell it in the next couple of months because Theta starts decaying a lot faster as we get closer to expiry. This contract, however, trades at a 97 delta. So this thing is basically all intrinsic value. So if you're not familiar, an options contract trades with intrinsic and extrinsic value. So extrinsic value is constituted of implied volatility and time decay. Time decay is represented as theta right over here. So every day that I hold this contract, I lose $2.51. We got to multiply this number by 100 because every options contract controls 100 shares or has the right to buy or sell 100 shares. Always multiply stuff by 100 whenever we look at the Greeks. The same thing with the delta. So this contract I hold today gives me exposure to 97 shares of Amazon for a fraction of the cost. And I bought this contract for $92.50. So $9,250. And it's now up to 14,170. So super happy with this trade. We're actually trading at 145 and it put a limit order at 150, which will bring our overall gain to around 65%. So super happy with this, but let's talk about Microsoft and why I went long with a double leverage ETF. So like I mentioned, I'm already pretty overweight with leaps, and I'll show you guys here in a second this website I like to use to predict my gains or losses whenever I get into a leaps call. And I'll give you a couple of examples here with the Amazon call and my Meta call and where I think they're going to land in the next couple of months. But I want to try to go along with a double leverage ETF. The only thing with leverage ETFs is volatility decay. Whenever we talk about leveraged, this cuts both ways. Microsoft, the actual underlying, went down a lot less, but because we have so much more exposure, we actually trade down a lot more. So as you can see, they were trading at $40.68. And back in March, they were trading at $21. Let's look at the Microsoft underlying so you guys have an idea of the difference. Let's see where Microsoft was at. So January 28th, Microsoft was trading at 481. So not as bad as the leveraged ETF. I think we had March 27th as a bottom. So as you can see, you only lost 26%, which is still a lot, from all-time highs there, or close to all-time highs from the 28th to the 27th, 26.3%. Pretty brutal, great entry point. But as you can see, if you buy at the wrong time at a leveraged ETF, you end up getting burnt really bad. And that's the problem with leverage ETFs. It's volatility decay. So that's a great example right there of why you should be careful with trading leverage ETFs and why I think going along with leaps is a superior option. However, I want to try something new and I'm already pretty overweight on leaps. That's why I went long with a leverage ETF, and you guys will see if it pays off or if I get caught in this trap. Let's talk about the options profit calculator website, and I'll show you guys what I'm talking about. So this is options profit calculator, and I'm not affiliated by any means with these people. This is a great website where you can see your P&L for your leaps or for whatever options contract that you're trading. So in this case right here, I have my Amazon leaps that I just showed you guys here in a second, expiring January 27th. So this is where we're at right now. So we're trading at 272.5. So as you guys just saw, I was at a 53% gain. So you see we're tracking. So if Amazon trades sideways up until January, I actually lose $500. And that's mainly because of Theta. I talked about Theta. It decays your contract's value every day. It is minimal because we're pretty deep in the money at this point with the 97 delta. So most of the value of the contract is intrinsic. This is something to think about because as you get closer to expiry, Theta starts to ramp up. So as you can see, if we trade sideways up until August, not much of a change. We're still at 51.3%. We lose maybe like a couple $100, right? Like $100, $200 up to August. But as you can see, as we get closer to expiry, we start losing a lot more money. So as you can see, my break even is 227.50. But let's say we're trading at something like 242, which is very probable. Amazon bounces up and down all the time. I thought Amazon was just going to shoot up to 300 whenever I bought the contract. It's been trading sideways and rising up every so often. We're actually closer to the 220s by expiry. Our Theta decay is actually a lot higher because our delta is lower. So as we get closer to the contract strike, we have less intrinsic value and more extrinsic value. So implied volatility and time decay will have more of an effect on our contract than our intrinsic value. So hopefully this is a good little explainer and visual of how that contract's going to behave given different prices. Let's say we reach 300, which that would be amazing if we do by, let's say, July or August, then my contract's up 80%. So that's something that I should think about as well. Even if I wait until January for Amazon to go up to 300, which is very likely they could, I could be missing out on another like 2 to 3 grand there. These are the inputs here. You just type the symbol and this fetches automatically. Then this is my call expiring January 2028. This is my 340 call, and I paid 32,400, like I shared with you guys and you guys saw. And I have this range right here from 600 to 900. Let's go calculate. This is my contract right here. If we're still trading at 610 in January of 2028, I lose $5,400, which, dude, it's like nothing. This is, I mean, the exposure you get from these contracts is just insane. Like the gains. So let's get off the high horse here and let's be realistic. Let's say Meta trades at a all-time high like they were trading at a couple of months ago. We're a 15K gain just because we bought a Leaps contract and we get more exposure to the upside. And of course, the downside too, like Meta could go down to 300. Like, I don't know what's going to happen with this stock, but I'm super bullish on it. They're trading at a very attractive PE ratio. AI platforms are getting better every day. Whenever they figure out AI and how to run ads with AI, with their distribution, it's going to be over. They're going to cook. This is how my contract is going to behave at different prices. So let's say Meta's trading at 900 tomorrow for some odd reason, which would be insane, like a 30% gain. My contract is now up 26K if we trade at these levels. So kind of cool to think about. This is something I use before I enter a trade. And I recommend you guys do as well, because you can have a visual of where your contract is going to land at different prices and at different times. And this is, of course, with IV being constant. If we play with the IV over here, it changes a little bit. Since our contract is so deep in the money, implied volatility won't do much of a difference here because extrinsic value is not as big, like I explained earlier. I want to share this with you guys, and hopefully you can add this to your arsenal whenever you're considering opening a trade. So hopefully you guys enjoyed today's episode. Shared a little bit more on my thought process on Amazon, how I think on Leaps, why I went long with a double leveraged ETF instead of the options that I usually like to go. And hopefully you guys enjoyed. Account sitting at 172.8. Happy with it so far, trading flat on the day. Let's see what happens. We were talking about some peace deals in Iran. We'll see what happens with that. It's been kind of crazy. So don't forget to subscribe. If you guys are still here, want to see you guys win, leave a like. I'll see y'all soon.